Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic financial statements analysis. In this question, you will calculate multiple ratios and then also analyze between two companies in terms of liquidity and provide suggestions for improvement. You could see the question on the left hand side of your screen, and on the right hand side, we've got all the workings which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. The following information was extracted from Bamford Stationery's accounting records for the year ended 31 December 2021. So here you can see we are given the net sales revenue, the gross profit, other income, operating expenses, and equity at the beginning of the year and at the end of the year. We are required in Part A to calculate the ratios and round off our answers to two decimal places. So let's start by first calculating the gross profit margin ratio. Now the gross profit margin simply can be calculated by dividing the gross profit with net sales revenue. Always remember, margin is just a synonym for net sales revenue. So the gross profit is given to us at $106,875 and the net sales revenue is given to us at $475,000, as you can see in the question. And we convert this into a percentage by multiplying with 100, which gives us a gross profit margin of 22.50%, rounded off to two decimal places. Next, we want to calculate the markup on cost. The markup is simply how much more in terms of selling price are we marking our cost to achieve a profit. So the markup can be calculated by simply dividing the gross profit with the cost of goods sold and then multiplying with 100. The gross profit is given in the question at $106,875, and the cost of goods sold is something we can calculate by simply subtracting the gross profit from the net sales revenue. So the net sales revenue is $475,000. The gross profit is $106,875. So that gives us altogether a total markup on cost of 29.03%. Okay. Now, in terms of the statement of financial performance, which you have seen before, we first start with the net sales revenue, then we show the cost of goods sold, right? And that gives us our gross profit. So if I want to find the cost of goods sold, which becomes the subject in this equation, then I can simply find the difference between the sales and gross profit, which should give our cost of goods sold. And that is what we have done here in the denominator. All right. Now, the third ratio we need to find is the profit margin ratio. Again, we have the word margin. So margin by default is always a synonym for net sales revenue. And in this case, it goes in the denominator. So in the numerator, we have the net profit or the profit for the year. And then we are multiplying the ratio with 100 to get our percentage into decimal places. Okay. So the profit for the year is simply the net sales revenue minus the cost of goods sold, which is the gross profit that is already given to us in the question at $106,875. Then we're adding the other income of $23,500, which is given in the question right beneath the gross profit number. And then we are subtracting all the expenses, which in this case is the total operating expenses of $67,400. And then we are dividing the entire thing with the net sales revenue, which is the margin of $475,000. And then you convert this into a percentage by multiplying with 100. That gives us 13.26%, rounded off to two decimal places. The last ratio we need to find is the return on equity. The return on equity is simply how much profit you have made by investing your equity. And the denominator in this case is the average equity, because equity is something that can increase in terms of what you had at the beginning of the year and at the end of the year. Because along the way, you can have additional capital contributions. You can also have retained earnings from profits that you make in the current year, which you decide to reinvest the next financial year. So when you find the return on equity, the formula must always have the average equity in the denominator. Now, the profit for the year is something we have already derived in the previous ratio but let me show you again how we get 62,975. So we just simply take the gross profit and then add the other income, which is OI here for short, and lastly we'll subtract the operating expenses. So the gross profit is given to us at 106,875. The gross profit is given to us at 23,500, and the operating expenses are given to us at 67,400, which if you do the math, I believe it should be 62,975. All right. Now, the average equity in the denominator, you can see we have simply added the two equities at the end and at the beginning of the year, which is 245,500 and 306,896. And then whatever the totals are, we then divide it by 2 to get the average, okay? Now, that gives us a final answer of 22.80% when converted into a percentage and rounded off to 2 decimal places. Now, what's happening in part B? Bamford Stationery has a return on equity of 18.92% in 2020, which is the previous financial year. Based on your answer in part A, which is the return on equity, specifically, advise potential investors if they should invest in Bamford Stationery. Now, the potential investors are obviously going to be happy given that Bamford Stationery's experienced a significant growth in the return on equity, increasing from 18.92% to 22.80%. What does that mean for the investors? That means for every dollar invested in Bamford, the amount of profit that you can make has gone up, which means for every dollar invested, you get 22.8 cents in return as profit, which is very good. And therefore, the investors are advised to invest in Bamford Stationery and foresee a potential growth in the future. Now let's answer part C. Patrick Supplies is a competitor of Bamford Stationery. The liquidity ratios of both businesses are shown below. So we are given the current ratio and the quick ratio for Bamford Stationery and the competitor Patrick Supplies. And we are required to comment on the liquidity of these two businesses by comparing the current ratio and the quick ratio. So just to give you an idea of how you can structure your response in the exam. So let's start with the current ratio. Based on the current ratio, we can see that Bamford has 2.3 current ratio while Patrick has 1.4. Now, this obviously means that Bamford has a significantly higher current ratio than Patrick, and therefore Bamford's 2.3 times, that result simply shows that Bamford has 2.3 times more current assets than current liabilities, all right? Okay, so what we understand is whatever current assets Bamford have in the business, they are 2.3 times more than what they have in terms of obligation or short-term liabilities. Now, in terms of the quick ratio, we can calculate the quick ratio by taking all the current assets, excluding the inventory, and then dividing it with the current liabilities. Now, if you check the results again for quick ratio given to us, we can see that Bamford's quick ratio is significantly low at 0.7, which has a drastic drawdown from the current ratio of 2.3. Doesn't that not tell us that most of the current assets that Bamford has are actually inventories which are in the books at the end of the financial year and are yet to be sold and converted into cash? Therefore, we can confidently say, based on the quick ratio comparison, that Bamford's current assets are mostly inventory. Therefore, this obviously justifies that Bamford has comparatively less cash than Patrick in terms of servicing the short-term obligations and the current liabilities immediately. All right? So in terms of comparing the liquidity, we are to touch both aspects and then do a comparison between the two companies. Now, what about part D? Suggest 2 ways to improve the liquidity of Bamford Stationery, which is something we have obviously highlighted at the moment, that the business has a lot of inventory and not enough cash, which is obviously a risk in running the operations moving forward. Now, we understand that Bamford is a stationery business and it obviously therefore should deal with stationery products, which could be varieties of products, right? Now, Bamford could obviously have suppliers for all the products they sell in their business. Therefore, in terms of having more cash available and improving your liquidity, what we could do is negotiate longer-term payment arrangements with supplier. So what happens is that we have more cash in our books to service off our short-term obligations. You could also discuss the just-in-time inventory management as a second point. So we are assuming Bamford and Patrick Supplies, they deal with the supply of stationery products, okay? So therefore, they deal with bulk products and bulk arrangements with their customers out there in the marketplace, such as they're distributing these products to small businesses out there in the economy. So therefore, Bamford could implement a just-in-time inventory management, which does not have cash tied to your inventory, but rather you have freed up cash. And every time you come into arrangements with new customers, you could perhaps enter into a cash sale arrangement, all right, where you could have a lot of cash in your books, and that should be always enough to service and pay off your short-term obligations. So when you structure your responses, you could apply multiple angles and construct a nice answer for full marks, okay? So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel, and check out the other lessons, and also check out the intensive programs we're running for POA 7087 and POA 7086 students in 2026, starting in the month of January. With that being said, I'll conclude today's lesson, and I'll see you in the next one.